December 2025, silver breaks through $70 per ounce for the first time in history. A 133% gain from the $30 level it started the year at, outpacing gold's 60% rise, crushing equity returns. Yet most investors still think of gold when they hear safe haven. They're missing the fundamental shift happening right now. The supply deficit stands at 117.6 million ounces for 2025, the fifth consecutive year of shortfall. Metal-focused projects, this continues into 2026 with a 30.5 million ounce deficit. Mine production peaked in 2016 and has declined since, hovering around 813 million ounces annually. Meanwhile, industrial demand alone hit a record 677.4 million ounces in 2025, up from 501.9 million in 2020. But here's what makes 2026 different. Silver isn't just benefiting from safe haven demand during economic uncertainty. It's becoming structurally critical to the global economy's transition to green energy. Solar panels require silver, electric vehicles need silver, AI data centers consume silver. These aren't speculative bubbles. These are infrastructure buildouts that will continue regardless of economic cycles. The gold to silver ratio sits at 79 to 83 ounces of silver per ounce of gold. The historical average is 60 to 66. At major peaks in 1980 and 2011, the ratio compressed to 32 and 40. Right now, silver is trading at a significant discount to gold relative to history. Analysts project the ratio could narrow to 40 to 50 by late 2026. This creates a paradox. Silver is behaving like a safe haven, rising during economic stress. But it's also being driven by industrial demand that grows during economic expansion. The dual nature gives silver something gold doesn't have, multiple drivers that don't depend on the same economic conditions. Let me show you exactly why silver is becoming the safe haven for 2026 and beyond. The fundamental story starts with supply and demand. And the math is brutal. Global silver demand in 2024 reached approximately 1.2 billion ounces. Total supply, including mine production and recycling, was about 1.08 billion ounces. That's a 120 million ounce deficit. The 2025 deficit narrows slightly to 117.6 million ounces, but remains structural and persistent. Mine production has been essentially flat or declining for years. About 75% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. Only 25% comes from primary silver mines. This creates a strange dynamic. Even with silver at record prices above $70, production doesn't respond quickly because miners aren't primarily targeting silver. If you're mining copper and silver as a byproduct, you make production decisions based on copper prices, not silver prices. When copper demand is weak, copper production slows, which reduces silver byproduct supply. This means silver supply is partially driven by the economics of other metals, creating inelastic supply response to price increases. The deficit has consumed above-ground inventories. Exchange inventories are at historically low levels. The Shanghai Futures Exchange reported its lowest silver stockpile since 2015. COMEX inventories have declined significantly. London vaults are tight. The physical silver available for immediate delivery has been steadily depleted over 5 years of persistent deficits. This isn't temporary. The Silver Institute project's deficits continuing through 2026 and potentially beyond. To bring supply into balance would require either massive increases in primary silver mining, which takes years to develop, or significant reductions in demand. Neither is likely given current conditions. New mine development faces challenges. Permitting takes years. Capital costs are high. Many of the richest, easiest to access deposits have already been mined. The silver that remains is often lower grade, deeper, or in more challenging locations. Even with prices at $70, it's not economically compelling enough to overcome these barriers quickly. Meanwhile, recycling provides only about 150 to 180 million ounces annually. Most industrial silver use is in applications where recovery is impractical or impossible. The tiny amounts of silver in solar panels, electronics, or batteries can't be economically recycled. It's gone forever once used. This contrasts with gold, where nearly all gold ever mined still exists in recoverable form. The structural deficit means that every year, more silver gets consumed than is produced. The above-ground stockpiles that buffer supply and demand get smaller. Eventually, you reach a point where no inventory remains to fill the gap. That's when price must rise enough to either curtail demand or incentivize production, increases dramatic enough to matter. We're approaching that inflection point now. While supply is constrained, demand is accelerating from multiple sectors simultaneously. This isn't speculative demand that disappears during downturns. This is structural industrial demand, driven by technology transitions that governments worldwide are mandating or heavily subsidizing. Solar photovoltaic technology ranks among the fastest growing sources of silver demand. In 2014, solar accounted for about 11% of total silver demand. By 2024, it reached 29%. The Silver Institute project's solar demand could exceed 300 million ounces annually by 2030, up from 230 million in 2024. That's a 30% increase in just 6 years. Why the explosive growth? 2 factors. First, solar installations are accelerating globally. The European Union targets 700 gigawatts of solar capacity by 2030. China continues massive build-outs. Even with potential U.S. policy changes, global momentum remains strong. Solar is becoming cost competitive with fossil fuels in many markets, reducing dependence on subsidies. Second, newer solar technologies like TOPCon cells require up to 50% more silver than traditional panels. The industry is moving toward higher efficiency designs that use more silver per panel, not less. While some efficiency improvements reduce silver loading per watt, the absolute silver consumption per panel is increasing with advanced technologies. Electric vehicles represent another structural demand driver. Standard EVs use 25 to 50 grams of silver, about 67 to 79% more than internal combustion vehicles. This silver goes into battery management systems, power electronics, charging infrastructure, and electrical contacts. As EV production scales, silver demand scales proportionally. Global EV production is expected to more than double by 2030. Even accounting for production slowdowns in some regions, the trajectory is clear. The Silver Institute forecasts automotive silver demand will grow at a 3.4% compound annual rate between 2025 and 2031. That's steady, predictable growth, regardless of economic cycles. The wild card is solid-state batteries. Current EVs use 25 to 50 grams of silver. If solid-state batteries using silver zinc or silver carbon technology become commercial, each EV might require a kilogram or more of silver. That's a 20 to 40 times increase per vehicle. This technology is still developmental, but if it scales, it would transform silver demand entirely. AI and data centers add another layer. The Silver Institute estimates total global IT power capacity increased approximately 53 times from 2000 to 2025, from 0.93 GW to nearly 50 GW. Each expansion in computing requires more hardware, which requires more silver. The metal is essential for high-speed data connections, power management, and thermal regulation. This sector is relatively insulated from economic downturns because governments worldwide classify data centers as critical infrastructure. AI development enjoys policy support, including grants, tax breaks, and fast-track approvals. The US, UK, EU, and China are all prioritizing AI capacity expansion. This governmental support creates demand that persists even during recessions. The US government designated silver as a critical mineral in 2025, acknowledging its strategic importance to technology and clean energy transitions. This classification matters because it can influence mining permitting, research funding, and trade policy. Silver has moved from precious metal to strategic resource. Add it all together, solar growing 15 to 20% annually. EVs growing 3.4% annually, AI infrastructure expanding rapidly. Medical applications, 5G technology, and other uses continuing. The industrial demand foundation is not only strong, it's accelerating. And because much of this demand is mandated or subsidized by governments, it's less sensitive to economic cycles than traditional industrial demand. Traditional safe haven assets like gold, treasury bonds, and the dollar benefit during economic stress. Investors flee risk assets and seek safety, but each traditional safe haven has problems in the current environment. Gold works as a hedge against currency debasement and inflation. But at over $4,000 per ounce, it's expensive for retail investors. Many people can't afford to buy meaningful positions. Central banks buy gold, but individual investors face high entry costs. This limits accessibility and reduces gold's appeal for everyday portfolio protection. Treasury bonds traditionally provide safety during stock market crashes. But with yields elevated and inflation concerns persistent, bonds aren't as attractive. If inflation reaccelerates in 2026, as some models predict, bondholders lose purchasing power even as principal is preserved nominally. Real returns on bonds could be negative. The dollar strengthens during global crises as a safe haven. But dollar strength hurts American exports, creates trade tensions, and doesn't provide returns. Holding cash is safe, but generates minimal yield while inflation erodes value. It's preservation, not protection. Silver offers something different. It provides safe haven characteristics, but with growth potential. The metal benefits from economic uncertainty through investment demand. Exchange-traded products absorbed 95 million ounces in the first half of 2025, pushing global holdings to 1.13 billion ounces, just 7% below all-time peaks. ETF inflows in Q3 2025 surged 40% quarter over quarter as investors sought exposure. But unlike gold, silver doesn't just benefit from fear. It also benefits from economic recovery and industrial expansion. This dual nature creates asymmetric returns. During stress, silver acts as a safe haven. During recovery, silver benefits from industrial demand. Either economic scenario is positive for silver. The gold to silver ratio quantifies this relative undervaluation. At 79 to 83 right now, the ratio is well above the 25-year average of 66 and the historical range of 15 to 80. This divergence signals structural imbalance. Silver is trading at a discount relative to gold. Historical patterns show that when the gold to silver ratio exceeds 80, silver often stages powerful rallies. In 2003, the ratio hit 80, and silver subsequently gained over 340% by 2011. In 2020, the ratio spiked to 125 during COVID panic. Then silver rallied from $12 to $30, a 150% gain in months. High ratios create reversion opportunities. Analysts project the ratio could narrow to 40 to 50 by 2026. This would mean silver significantly outperforming gold. If gold stays at $4,000 and the ratio falls to 50, silver would trade at $80. If the ratio compresses to 40, silver reaches $100. These aren't speculative targets. They're based on historical mean reversion patterns. The affordability factor matters more than many realize. Silver at $70 per ounce is accessible to retail investors in ways gold at $4,000 is not. You can buy 10 ounces of silver for $700. That's meaningful portfolio allocation for middle-class investors. Gold requires $40,000 for the same 10-ounce position. The lower entry barrier makes silver more liquid for regular investors. Moreover, silver's smaller market size amplifies price movements. Total above-ground silver stocks are estimated around 2 billion ounces, worth roughly $140 billion at current prices. Gold's above-ground stocks exceed 200,000 tons, worth over $32 trillion. Silver's market is about 200 times smaller. The same dollar inflow moves silver prices much more dramatically than gold prices. This creates volatility, which is a feature, not a bug for investors seeking returns. Gold provides stability but modest upside. Silver provides volatility but substantial upside. In a portfolio context, the combination balances risk and return more effectively than either metal alone. Multiple catalysts are aligning specifically for 2026 that make silver's case even stronger. These aren't speculative predictions. They're scheduled events and confirmed trends. Federal Reserve policy is expected to shift toward rate cuts in 2026. Real interest rates, nominal rates minus inflation, are projected to turn negative. This diminishes the appeal of cash and bonds while boosting demand for non-yielding assets like precious metals. Rate cuts reduce the opportunity cost of holding silver, which pays no interest. A weaker dollar typically accompanies rate cuts. Dollar strength compressed in 2024 as the Fed paused rate hikes. If cuts begin in 2026, the dollar could weaken further. Commodities, including silver, are dollar-denominated, so dollar weakness translates directly to higher commodity prices. Silver becomes cheaper for non-US buyers, increasing international demand. Geopolitical risks remain elevated. Trade tensions, regional conflicts, and political instability create ongoing uncertainty. While gold traditionally benefits more from geopolitics, silver increasingly benefits from its dual role. Investors seeking safe haven exposure but at more affordable price points turn to silver as poor man's gold with industrial upside. The commercial real estate crisis and potential recession in 2026 paradoxically help silver. Economic weakness drives safe haven demand. But the recession will likely be short and followed by aggressive stimulus. That stimulus will flow into green energy infrastructure, which requires silver. The down-then-up economic pattern benefits silver on both sides. China's economy specifically matters for silver. Despite current weakness, China is the world's largest solar panel producer and a major EV market. Chinese government policy heavily favors both sectors. Even if China's overall economy struggles, directed investment into solar and EV production continues. This targeted industrial demand remains strong regardless of broader economic conditions. The supply-response lag is another 2026 catalyst. Even with prices at $70, significant new supply won't arrive for years. Mining projects take 5 to 10 years from discovery to production. Projects starting development now won't produce meaningful output until 2030 or later. The supply deficit continues through at least 2026 and probably 2027-2028. Investor positioning creates momentum. Many institutional investors remain underweight silver. Portfolio allocation models based on historical norms would suggest much higher silver exposure than most funds currently hold. As more institutions recognize the supply-demand fundamentals and relative valuation, capital flows could accelerate. ETF additions of 187 million ounces year-to-date in 2025 could expand in 2026. Objectivity requires acknowledging the risks. Silver isn't a perfect safe haven. It has vulnerabilities that investors must understand. Volatility is the primary risk. Silver's price swings are nearly double gold's. Daily moves of 5% or more are common during volatile periods. This volatility can shake out weak hands even when the fundamental thesis is correct. Investors who can't tolerate sharp drawdowns shouldn't overweight silver. The industrial demand that's silver's strength is also a vulnerability. If a global recession is deeper than expected, industrial demand could decline significantly. Solar installation rates could slow, EV production could stall. While this demand eventually recovers, the timing matters. Investors entering in 2026 might face a period of weak industrial demand if recession hits hard. Substitution risk exists, though it's often overstated. With prices above $60, manufacturers have incentive to reduce silver use or find alternatives. The solar industry has improved silver thrifting, using less silver per panel through better efficiency. TopCon technologies partially offset this, but the trend toward using less silver per unit of output is real. However, substitution is limited by silver's unique properties. It's the best conductor of electricity and heat of all metals at room temperature. In many applications, no substitute provides the same performance. Where substitutes exist, they often come with performance trade-offs that manufacturers resist. Regulatory and policy risk surrounds both safe haven and industrial use. Changes in government solar subsidies could reduce installation rates. Trade policy could affect silver flows. China is a major silver producer and consumer. Any disruption to Chinese markets affects global silver significantly. The paper silver versus physical silver debate introduces complexity. Exchange-traded products and futures markets create substantial notional silver exposure. Some argue this paper market suppresses physical prices through leverage. If true, it creates risk that paper and physical markets disconnect during stress, creating chaos that's hard for retail investors to navigate. Liquidity, while generally good, can evaporate during extreme stress. In March 2020, silver markets seized up temporarily. Physical premiums over spot prices spiked to $5 or more per ounce as dealers couldn't source inventory. This liquidity risk means that silver's safe haven properties can temporarily fail precisely when investors need them most, though this is usually brief. Finally, silver lacks the cultural and institutional acceptance gold enjoys. Central banks hold gold, not silver. Jewelry demand for gold exceeds that for silver by wide margins. This limits silver's appeal in certain markets and among certain investor types. The perception of silver as inferior to gold persists despite strong fundamentals. Understanding silver's transformation into a safe haven doesn't automatically translate into portfolio decisions. Context matters. Silver fits specific portfolio roles better than others. For investors seeking pure capital preservation, gold remains superior. Its lower volatility and deeper liquidity make it better for wealth protection during severe stress. Silver's volatility creates drawdowns that preservation-focused investors can't tolerate. But for investors seeking growth within a defensive allocation, silver is compelling. The dual demand drivers create upside potential that gold lacks. The supply deficit creates fundamental support. The undervaluation relative to gold via the ratio creates mean reversion potential. And the 2026 catalysts align favorably. Allocation strategy depends on risk tolerance and investment horizon. Conservative investors might hold 5 to 10% of portfolio in precious metals, split 70% gold and 30% silver. This preserves gold's stability while capturing silver's upside potential in reasonable proportion. Moderate investors might increase to 10 to 15% precious metals with 50-50 gold-silver split, or even 60% silver, 40% gold. This overweights the higher potential asset while maintaining some gold exposure for stability. Aggressive investors comfortable with volatility might hold 15 to 20% precious metals, weighted 70% silver, 30% gold, or even pure silver exposure. This maximizes return potential, but requires psychological ability to withstand 20 to 30% drawdowns. Implementation matters. Physical silver offers direct exposure, but comes with storage and insurance costs, plus less liquidity. ETFs like SLV provide paper exposure with lower costs and better liquidity, but introduce counterparty risk. Silver miners offer leveraged exposure to price increases, but carry company-specific risks. Timing strategies using the gold to silver ratio can enhance returns. When the ratio exceeds 80, favor silver. When it compresses below 60, rotate toward gold. This contrarian approach buys whichever metal is relatively cheap and sells whichever is relatively expensive. Tax considerations affect after-tax returns significantly. In the US, physical precious metals are taxed as collectibles at 28% long-term capital gains rate, higher than the 15 to 20% rate for stocks. ETFs structured as grantor trusts face the same treatment. Certain mining stocks or ETFs structured differently might qualify for more favorable tax treatment. Consult tax professionals before implementing. Is silver the new safe haven for 2026? The answer is nuanced. Silver is becoming a safe haven, but with different characteristics than traditional safe havens. It's not replacing gold, it's complementing it. Traditional safe havens like gold provide stability during stress. Silver provides something different. Optionality. It benefits from economic stress through safe haven demand. It benefits from economic recovery through industrial demand. And it benefits from long-term structural shifts toward green energy regardless of economic cycles. The supply deficit, structural industrial demand, relative undervaluation to gold, and 2026 specific catalysts create a compelling fundamental case. The risks are real, but manageable for investors who understand them and size positions appropriately. For 2026 specifically, the confluence of factors suggests silver could significantly outperform both gold and equities. The supply deficit continues. Industrial demand accelerates. Fed policy becomes accommodative. Geopolitical risks persist. And the gold-to-silver ratio sits at levels that historically precede powerful silver rallies. Whether silver reaches the bullish targets of $100 or even $133 that some analysts project is uncertain. But the case for silver, significantly outperforming in 2026, doesn't require those extreme targets. Even reaching $80 to $90 represents substantial gains from current $70 levels. The transformation of silver from a purely precious metal to strategic industrial commodity with safe haven characteristics is complete. Investors who recognize this shift in position accordingly have opportunity. Those who think of silver only as cheap gold or industrial metal will miss the nuanced reality of its dual nature. Silver in 2026 offers something rare: fundamental supply-demand tightness, structural industrial growth, safe haven optionality, and relative undervaluation all at once. That combination doesn't occur often. When it does, it creates generational investment opportunities. The question isn't whether silver is a safe haven. The question is whether you understand that safe haven now means something different than it did in previous cycles. Silver is the safe haven for an economy transitioning to clean energy during a period of financial stress. That's the 2026 reality.